for 30 years of investing assets, I came to work every day only focused on one thing, interest rates. And the issue that Josh brings up is right, except for one thing. Rates shouldn't be this low, Josh, if we are in this continued earnings growth scenario.
Sure they should.
Because
the economy is a global economy, and our rates are being anchored by what's happening in the rest of the world.
Exactly. So I'm not disagreeing with what's happening in Europe, what's happening in Spain, what's happening in New Zealand. But if we are going to continue to grow the economy here, one of two things is going to happen. Either the stock market is going to have a completely different balance with interest rates, like we've never had before, where we're going to have low rates and we're going to have continued earnings growth. And so that whole symbiosis is going to be broken. And if that's the case, then it's going to have a whole different meaning for how you're going to invest assets, call it for the next 20 years. If you're right that low interest rates around the world means that low interest rates are going to stay here.
I just agree that the Fed sets interest rates overnight, but demand for Treasury bonds and inflation expectations are what sets rates 10 years and out on bonds, because to me, that's really what's dictating the picture, not dot plots.
Yep. Well, I'm not surprised about rates. I mean, Scott, we've had this discussion for a couple of years, not on air for the last couple of years. And a lot of people that have come on air talked for higher rates. I did not see it. I see deflation around the world. I'm just back from Japan. I'm just back from Asia. Deflation is real. It's around the world. But if you don't believe that interest rates and have a long-term impact on stock prices, then what you're saying is the paradigm that's existed for 100 years doesn't exist anymore.
Just saying, you know, what the market's become conditioned to and what it's gotten used to, obviously, over the last 10 years. The crisis is an ability for the stock market to go higher in the face of interest rates that are lower. There is no alternative. Where else are you going to put your money? It's the same old debate, but it's legit. There's no real thought that interest rates are going to rise anytime soon, is there? I mean, the Fed made this great pivot.
I mean, I certainly don't think it. I don't see a scenario where the Fed, who had a glide path a year and a half ago, they're off of that path. And what they did in December basically told you and told market participants, we're going to keep rates low. And so I don't see a scenario where rates are going to go up.
In other words, in the past where you'd say, OK, maybe the bond market's getting it right in this scenario because rates keep going down. The stock guys are getting it wrong. This way, rates have been so distorted over the last 10 years that story's different now. I know people say, oh, it's never different now. But maybe it is actually different now.
Well, let's see, because the history has always said that the bond market is smarter than the stock market. Nobody can dispute that over the long term. The long-term interest rates are always right. We don't know what's happening right now because we're in a different world. As Josh pointed out, it's now a global fixed income market. The fixed income markets, if you want to define it, are probably 10 times globally, gray markets, black markets, actual listed traded markets, 10 times the size of global equity markets.
Sure.
They get it right in the long term.
So, Steph, you take a look, and you could easily make a case on either side of our key question today. You can look at, the issues with Huawei or, earnings and margins being impacted by the trade war. I could point to multiple notes, whether it's a Morgan Stanley comment or a Goldman Sachs comment. They talk about margins. Morgan Stanley talks about tariffs hitting home, et cetera. I could fall behind that easily. But then I've got this other side of the ledger, which we just talked about with Josh and Gary, of Goldilocks.
Right.
You've got growth. You have no inflation. You have earnings, which are good enough. Yeah, where else are you going to put your money in this environment? Who wins?
Well, I mean, I look at trade, and we have to get a resolution. So I think we're in a trading range in the market until you get some sort of understanding. Trade by itself is only going to impact the U.S. economy 3 to 4/10%. That's what it's going to hit. Much bigger for China, almost like 1% for China. So it's bigger for them. But for us, I think it's manageable. Where it gets a little dicey is, what does this do to sentiment? What does this do to business confidence and CapEx? What does this do to the consumer? And I think the longer this goes on, the more pressure you're going to see on that front. And then that's going to weigh on the multiple, on what you're willing to pay, no matter how low interest rates are. People are not going to bid up this market and bid up the multiple with this as an overhang. So that's where, it gets dicey. Now, there are opportunities where you can buy, and that's kind of what I've been doing, picking very slowly, very small each day, because you just don't know. The headlines change every minute.
So you can't have a higher level of conviction unless you get the trade war resolved.
And that's what I believe.
Even with the more positive side that I played for you, the other side weighs so much on sentiment and psyche that has a real impact on where stocks can go.
I do. I mean, I think certain sectors can work, certain stocks can work, but it's been a very defensive tape in the last month as this rhetoric has increased. So it's really going to depend on what you own, and it's also a stock picker's market this year, for sure.
Can't get out, Pete, of this range that we've been in.
Yeah.
What does it?
Well, obviously,
only a trade deal?
I think a trade deal is really what everybody's looking at. Yeah, I mean, I think that's the central focus that we're seeing here. I mean, we all see rates. We know they're extremely low. We all see the growth, and we all think that's very impressive. But where do you put your money right now? I mean, and everybody, the hesitation becomes, all right, when's this trade deal going to get done? How far extended is this going to be? I mean, we already had the auto tariffs extended out. Now, all of a sudden, you got this Huawei extended out 90 days. So it's giving us an opportunity, I think, looking forward. But it makes it a little more difficult, Scott, because you're still looking at these companies that if indeed they can't reach any kind of a deal, that's going to be something that the psyche of the market will not be able to tolerate. And then you're going to see a pretty harsh sell-off.